Okay, let's get going. Welcome everybody, those of you who are here in the room, listening in, or wherever you happen to be in the world watching. Monetary Policy Report, summer of 2011. Per Jansson and myself will go through all the arguments when it comes to our design of Swedish monetary policy presently, and how we look at what's happening in the world. The main message this time is that, as far as we can judge, we see stable development in the Swedish economy over the coming years. As you're maybe aware, we're coming from a situation where, at least in a historic perspective, growth has been extremely high. And that means that eventually growth will have to slow down, but the way we look at it this time is that will happen gradually and from a very high level. So we are sort of moving towards a period of normalization. What that also implies when it comes to monetary policy and the level of the policy rate is that, as far as we can judge, the policy rate will continue to go up over the foreseeable future because we're starting at a low level. And that means that the policy rate also will have to be normalized in the course of the period that we're looking at this time. But as always, and particularly this time, what is going on in the Swedish economy is also greatly actually affected by what's going on in the rest of the world. And there are a number of uncertainties out there that might affect us one way or the other. Not that it really has changed things the way we look at the Swedish economy presently. But these are still sort of unknowns that one needs to be mindful of, because if things change dramatically, then of course things change here as well. Two examples is what's going on in the U.S. economy, because things have been moving more slowly there than many have expected. And then another example is, of course, what is going on in Southern Europe when it comes to various countries struggling with their debts. And in particular, presently, what is going on in Greece, and to what extent that could then have second-round effects in the northern parts of Europe. But when it comes to the overall picture, if you look at the global economic outlook, it is still divided. The picture sort of is roughly the same it has been in the past, basically saying that on the one hand we have a few very large economies where growth is very high. You could actually add other countries to this in Asia and other places, and we're talking about growth levels that are far higher than what we are used to in our part of the world. What goes also with those growth numbers is actually a monetary policy which requires nominally much higher interest rates than we have here. Well, then at the other end of the spectrum, you have Europe, which has much slower growth. The U.S. somewhere in between. The growth numbers in the U.S. aren't really all that bad, but more what they have to deal with at the same time is their unemployment level. And for us, then, what this all adds up to is basically global growth at around 4% plus a little bit more than that, and global growth, as far as we and others can see, will stay stable over this period. And that is, of course, then something that also means a bit of stability when it comes to the Swedish economy, despite the things that are going on in Greece and a number of countries with difficulties that they have to deal with. Part of this uncertainty is what's going on in Greece, Ireland, Portugal, here expressed in terms of the 10-year bond rates. This can, of course, be depicted in many different ways. There are two parts to this. One is what is going on in the short run, which is basically dealing with putting together packages of various types, trying to deal with cash flow issues in, let's say, Greece in the short run. But on the other hand, one also needs to be aware of the long-term issues that this will take a number of years to sort out among those countries where they have problems with their debt levels. And we actually have a box in the report dealing with sort of how one can think about these things and how long it will take, not only to deal with the acute issues dealing with how to make payments in the short run, but also what it takes actually over time in order to restore the situation to something which is more stable. But having said that, now when it comes to us and the Swedish economy, whatever comes out of this, if things really were to change, for us, we're talking about second round effects in one way or the other, because economically these are not countries that are that important when it comes to, let's say Swedish exports. So in terms of the uncertainty that goes with this, we have seen no reason to sort of change our projections presently. At the same time, if you look at the Swedish economy and what has happened in the past, in earlier episodes with a lot of uncertainty, the krona has had a tendency to depreciate and sometimes actually depreciate substantially. Given that we think that we have a fairly stable period ahead of us, our projection here is basically that the krona might appreciate a bit, because the growth numbers are higher for us than in a number of other countries, and as far as we can judge, the interest rate differential will also, between us, let's say, and the euro area and the US, will push the krona in an appreciating direction. But having said that, these types of projections are very, very hard to do. But basically, we think that most of the appreciation has already happened, and that's why our assumption is that the krona will stay fairly stable in the period ahead. And when you then translate this into what's going on in the Swedish economy, which can of course again be depicted in many different ways, as you can see here, we have had these very large gyrations when you look at the numbers, with the exports first falling by a little bit more than 15% and then increasing by almost 15%. And those numbers are very large. That's not likely to continue. When we go through a normalization process, exports will go back towards more normal numbers, slightly higher than 5%. Investments tend to lag a bit, but the investments will also stay at a fairly high level, but also going down towards 5%. And then, as you can see here, looking at consumption, when you look at the consumption numbers, they're also sort of reasonable in the sense that there's nothing sort of dramatic going on that side either. And that means that when you translate this into growth numbers, this is what we get, basically saying that towards the end of the period we'll end up in the range 2 to 2.5%, and those are sort of growth numbers that we recognize. Now, approaching that interval, it's perhaps not so surprising then that when you go down from the very high growth numbers that we have observed, something actually will have to slow down in the economy, because otherwise we just wouldn't get to this range. Now, as a consequence of this, and also what has happened in the past year or so, where actually things ended up turning out much stronger than we expected, let's say in July a year ago, then of course you'll see improvement in the labor market, and here we think that unemployment will basically keep falling one way or the other during the course of the period that we are looking at here. This is a projection. We also have in the report a box where we argue back and forth about what factors one would need to look at or deal with when it comes to the functioning of the labor market if the unemployment numbers were to fall below 6% or maybe even substantially below 6%. But those issues are basically outside the realm of monetary policy. But the conclusion that we reach in that section is basically that it would take active labor market policies in one form or the other if this were to change substantially compared to what we have in our projections here. And if this then is translated into potential wage increases, our judgment is that also this time the wage negotiations are most likely to result in sort of fairly normal nominal wage increases, because those levels that we have here in our projection represents levels that have produced substantial increases in real wages over the past 10 to 15 years, and we see no reason to think that it wouldn't happen this time either, given that the history here has been so favorable. And then again, eventually getting closer to monetary policy, if this is then, all of this is then factored into our inflation projections, you can see here quite large differences between the various measures, starting with the yellow line, which is the consumer price index, excluding both interest rates and energy. And measured in that way, you can see that the inflation rate is presently low. It's sort of hovering around 1%, a little bit above 1%, but then eventually actually goes back up towards 2%. Taking out interest rates, you can see the blue dotted line. You can see there a projection, an evolution which is quite similar, and that means that given the general aggregate demand in the Swedish economy, being that coming sort of from exports or domestically, this is sort of what we think is likely to happen. At the same time, though, and this sort of follows from the construction of our CPI, which includes interest payments on mortgages, this then also implies that the CPI will stay substantially about 2% during the entire period. But if this were if these numbers were to be stretched a few more years out, then CPI and CPIF would more or less over time coincide. And if you look at this particular graph, if you look at 04, 05, and 06, then you can see that the correlation is much closer. So it sort of takes a number of years before the kind of episode we've been through in the past few years, and including our expected interest rate rises in the future, before this sort of disappears out of the CPI. And if you look at expectations, they're pretty much in line with our forecast, because in the short run, when the inflation rate goes up, then also inflation expectations tend to go up, and that is what has happened. And then at the same time, if you look at this sort of 5 years out, you can see the blue dot there, which is fairly close to our own projection. And that means that, as far as we can judge presently, inflation expectations appear to be well anchored, and that's of course a nice thing, the way we look at how to conduct monetary policy. Because if that were not to be the case, then the situation would be actually quite different. And higher interest rate, higher policy rate in this setting contributes to a stable economic development. And I haven't really looked at these interest rates in the past, but it's quite rare, though, when it comes to making these projections, that there have been relatively few changes between what we said in April and this time. And all things considered, that meant that this time around we didn't really see enough of a reason to change the repo rate path. So it stays the same, and basically saying that we're going through a process of normalization. That means that, given that we're coming from a situation where with a very low nominal interest rate level in this country, things will have to normalize over time, and that implies gradual interest rate increases on our side. And here, the way this graph has been drawn, the rate approaches 3.8%. But, as always, despite the fact that this time around the path ended up being the same as the time as in April, it's a forecast. It's not a promise. Various things can happen, and we have argued about some of those potential other scenarios in Chapter 2. One such scenario is a wage-driven inflation, because if the wage increases were to be much higher than what we have expected, that implies more inflation, and then we would have to compensate for that, and the interest rate path would move to the left. On the other hand, we have what happens if there were to be weaker international economic activity. Well, then, of course, exports would slow down. That would affect the Swedish economy. And if something were to happen, let's say in Greece or wherever, and that would spread so that we would end up with secondary effects via the financial sector in one form or the other, that would also affect us gradually. And then that would mean a reduction in aggregate demand, slower inflation, and then that would push the interest rate path to the right. Now, as an example of what we're talking about here, Per has prepared a number of slides, and you can also find all the arguments and more in the report dealing with this particular issue. What happens if a country runs into serious difficulties when it comes to the debt level? Per.
Okay, thanks. So I guess due to the problems and also because of the general situation, there has been a renewed focus on the fiscal problems in many countries. One of the factors in this, of course, is at this time, as you very well know, we have sizable risk premia in the pricing for many countries, and that's, of course, an issue of great concern for these countries. So we do various things in the report to try to approach this problem. One is to do a scenario where we try to combine, on the one hand, a deteriorating fiscal situation in Europe in general with some sort of financial market stress, and that's something you can look at in Chapter 2. It's, of course, extremely hard to do. It's extremely hard to quantify these effects that come via financial markets, and they work themselves through the economy via confidence effects, so that's difficult, but we've done at least an attempt to highlight what that might mean. And we also have a box in the report where we try to look at the severity of the fiscal sustainability problems, and also try to see at the differences between some of the countries, and that's the box that I wanted to talk to you a little bit more about. So basically, the box here starts from scenarios that are done by the IMF regularly in its IMF Fiscal Monitor report. And what they do there is that they basically ask what sort of primary surpluses will these economies have to generate in order to sometime in the future stabilize debt around 60%. And the particular consolidation strategy that they assume is that the primary surpluses will increase gradually up to 2020 and then stay at some specific level up to 2030 such that the debt is stabilized at 60%. That's, you could assume other consolidation strategies, but that's what they do. And I guess one motivation for that, at least for European countries, is that the Growth and Stability Pact spells out that the maximum debt ratio should be 60%. Okay, and so what we do in this box is then to look a little bit at the robustness of this consolidation strategy and try to change some of the key assumptions that the fund used to see what happens then to these scenarios. And just to quickly already right now summarize the conclusions, which none of these might be very surprising to you, but it turns out, of course, to be a big challenge for many countries to achieve this sort of consolidation path. And you might even think of the IMF scenario as in a sense being a bit optimistic, and I will come to that shortly. There's an urgent need in all of these countries to undertake a combination of structural and institutional reforms in order to improve the future path for fiscal and also to achieve some credibility for fiscal policy ahead. And in terms of differences between countries, it looks a little bit better for countries like Spain and Italy than countries that already have European Union IMF programs. But there too, there's a need to do some reforms, in particular to strengthen credibility. So what the fund does, and this is something you might have seen before, is that they take their point of departure in a simple equation that describes the change in the debt ratio, which is D here, as a function of the initial debt level, the period before, and primary surpluses. And there's a parameter here that is this R minus G divided by 1 plus G, which I will call the growth-adjusted interest rate. That links in an important way the initial debt level to the change in the debt ratio ahead. And as you can see from this, the requirements on the primary balances, this is P, they will depend and increase if the initial debt ratio is high, and they will also increase if borrowing costs are high, and they will increase if growth is low. So basically these are the three variables that are important then for the requirements on the primary surpluses. And in the fund scenario, they assume that this growth-adjusted interest rate parameter will be around 1%, which is the average that you get for advanced countries over the period 91 to 2008. So let's then first take a look at some of the assumptions that the fund make. First of all, you can see that you have here the debt ratios in some of these countries at 2010, and you can see that for many countries the debt ratio is high, and there's some evidence that the fund itself provides that shows that this growth-adjusted interest rate depends on the debt level. So the fund makes some estimations showing that if the debt level exceeds 90%, then that growth-adjusted interest rate coefficient tends to get twice as high as it is before. So in the estimations, it goes from around 1% to 3% instead. So this is then one reason for why the fund's scenarios might be a bit optimistic, given that the debt levels are already quite high in these countries. Another factor is if you look at the second row, you can see the implied requirements on the primary balance in the fund scenario. And you can see that for many countries, those requirements are far higher than what the countries have been able to do historically if you look 10 years back or so. And for some countries, substantially higher. If you look at, for example, Greece, they have to end up with a primary surplus at 7.5, whereas they've been doing around 0 in terms of an average between 2000 and 2007. So this is a second argument for why there might be some optimism in the fund scenario. A third is that they do not, in this kind of scenarios at all, take into account that there will be demographic changes ahead for many of these countries, which will put pressure on both cost and income. And you know this before, but you can see that this will be a sizable pressure on the cost side for many of the countries, and that's not part of these scenarios. So this is the non-dashed lines are the lines taken from the base scenarios done by the IMF, and the dashed lines are those produced by us, where we vary this assumption in terms of the average primary balance. So instead of putting in the ones required by this consolidation strategy that I was explaining before, we just put in the average that the countries have achieved over the period 2000 to 2007. And you can see that in terms of, for example, here Spain, you can see that things look a little bit better than in the IMF scenario, and that's because Spain has had an okay performance in terms of generating primary surpluses over the period. In Italy, it's also true that they had an okay performance in terms of generating primary surpluses over that period, but the initial debt level is much higher, so therefore more is required from Italy than from Spain to get the debt level down. So if you change that assumption, you would end up with a debt level that is much higher than in the fund scenario. And you can see in the case of Portugal that things derail rather heavily, so the debt ratio is exploding if they perform as they have over the period 2000 to 2007. The next sort of robustness analysis is to change this growth-adjusted interest rate assumption. So again, you have here you have the heavily dashed lines are those that put in the more pessimistic assumptions for Spain and Italy in this case. And you can see that although changing the primary balance assumption does not hurt the countries in the sense that debt ratios still go down, but that would change if you would have a change in this growth-adjusted interest rate assumption. You can see that it's more problematic again for Italy than for Spain, and that again relates to the fact that Italy starts with a higher initial debt level, so that means that they are more sensitive to increased borrowing costs than Spain is. So, okay, to sum up then, there are a couple of conclusions that we arrive at in this box, so all of them, I guess, pretty obvious ones. The first is that stabilizing debt around a reasonable level is a big challenge for many countries. And as I try to highlight the IMF scenario, I mean, it would be a bit odd to say that it's a bright scenario. It's not a bright scenario, but it's easy to make realistic changes in their assumptions and produce even worse scenarios for these countries. So indeed, it's a quite big challenge for many of these countries. There's a need for a combination of structural and institutional reforms to improve the future fiscal path and credibility for many countries, and only dealing with acute problems will not be enough. It's sort of a necessary conditions, but not a sufficient conditions to arrive at a better development in the future than we have had in the past. And in terms of Italy and in particular Spain, there's a slightly better situation than for the countries currently in the programs of the European Union, the IMF, and the reasons being that they have performed better in terms of the history of primary balances, they have lower expected costs from demographic changes, but they nevertheless must ensure credibility, in particular to avoid the kind of borrowing cost shocks that would create a threat to their sustainability. So also their reforms in terms of improving structure and institutional factors are needed.
Yeah, the IMF used to show up here in the early 90s to show us graphs of that type, so you should be happy that I can summarize instead and say that as far as I can see and we can see, we'll have a stable development in the Swedish economy over the years ahead, and actually stable, but with growth rates coming down from a very, very high level. And in that environment, we have to live with the uncertainty around us that we cannot change. But nonetheless, we are going through a process of normalization, and normalization also in this environment means that as far as we can judge, the repo rate will continue going up during the period that we're talking about here, because if that happens, then we can also meet our inflation target. Questions, reflections on this?
Unmuted.
Okay, I have two questions regarding your alternative scenario with a severe sovereign crisis. My first question is, you're mentioning widening spreads as one kind of positive effect that would affect the macro outlook. It would be interesting to hear what sort of particular spreads you are estimating that will be affected. If it's mainly on the corporate side or on the household side, etc. And the second question regarding this alternative scenario, it seems like you assume that the krona will remain stable. And I am questioning this assumption, since this is not really the historical pattern of the krona. We know from example, the recent financial crisis, that it's very sensitive to the cyclical downturn and widening risk premium. So why can you make such a hard assumption on the krona in this scenario?
Yes. Okay, so let me start with the krona. we try to discuss in the second chapter exactly what you're saying, that it's perfectly conceivable that things would happen to the kroner. Most of the time, I guess the impression is that when the storm gets heavier out there, then indeed the kroner depreciates, and that's a pattern I guess we've seen mildly again now as things went wrong with Greece. There was a tendency for the kroner to depreciate again. So I guess that's a fair point. And we had such a scenario, I can't remember if it was in the last policy report or in the report before that, where we assumed precisely that the krona would depreciate. And we thought it would be, at least not unreasonable to do variation of that, given that some have argued, that if the storm gets really heavy, then things may change and the krona might actually display stability, because then it would be even more difficult for people to find, safe havens where to invest. But you're perfectly right that that's something that you could make other assumptions about, and in that case I would refer you back to the report where we had a scenario which is similar but where the krona did depreciate. On the first question, that's a very hard thing. I guess the fair thing to say is that we try to combine both models to the extent we had some, which aren't many. I mean, we have a spread, I think in the general equilibrium model that we have, but it's not the sort of spread that you think about in terms of these circumstances. So you have to combine that with off-model evidence the best you can, and then apply judgment and assume that these effects will be, bigger than otherwise. But it's extremely hard, and I can't describe to you exactly how, the numbers were cooked up, but it's at least reasonable to assume that a large part of these things you miss a large part if you just go via these normal trade channels and the kroner effects that you normally would look at in these circumstances.
Yeah. I think it's interesting. Two things actually. First of all, the box where we should just describe it by the scenario, because I think, and I think also detected with you, a certain skepticism, and I think that everyone in this room can't take the IMF projection seriously. I mean, really, everyone knows that the interest rate is not going to be slightly more than 1 percentage point higher than nominal growth in Greece within the foreseeable future. So the question is, why at all make a box where you don't draw any realistic conclusions? That's the first question. The second is, have you thought about why the market reacted the way it did today? You did come out with a monetary policy report that was a great deal more hawkish, I think, than the market has discounted. And still the market shrugs, which can be interpreted as the market is in total disbelief of your rate monetary policy path, even though it's a forecast and not a promise. So do you feel that your credibility is being undermined in a way recently? So two questions which I think are interconnected.
Well, I mean, on the first one, what we wanted to do with the box is sort of to catch the main issues. Then all sorts of people who are interested in this can do all sorts of numbers when it comes to putting them into the equation. What we wanted to do is to illustrate, to get somewhat of a handle on what these things look like, and particularly what it implies over time, because there's a tendency to sort of discuss one country at a time and discuss it sort of in terms of who is agreeing to what or who is not agreeing to what within the next 2 weeks, and something along those lines. And what we wanted to make clear here is that regardless of how you do the numbers, a number of countries will be stuck with this for many years to come. So it's not only the issue, but what headlines do you find in the newspapers the next day or so. This is something which will take a while to fix. When it comes to monetary policy, this is what monetary policy is, and this is what we believe in. That market reactions today, well, there's not much to say about that. I mean, not very much happened, and in some sense, one can say that that's a good sign. But on the other hand, I mean, one day That's not what makes monetary policy. What makes monetary policy is to consistently over a time period to do something that is in line with the inflation target that we have. And one of the characteristics of the period that we have gone through the past year is that with so many things happening in other parts of the world, and with so many sort of arguments back and forth when it comes to where interest rates should end up, and I'm talking about longer rates. It's not so easy to just take the implied rates and look at them at a given moment in time and say that they have a certain meaning in one way or the other. We're just going to have to live with this in an environment where things are likely to move around quite a lot, and we just have to live with that and do monetary policy as best as we can. We certainly feel comfortable with what we're doing.
Can I just ask, I don't have any comments on the second question, but on the first one, we never claimed that, percent growth adjusted interest rate would be reasonable to Greece. Greece wasn't even part of the analysis. I'm not sure that, it would be that unrealistic for other countries, and the point was not, to single out the perfect numbers for this. The point was to look at the sensitivity of what happens in light of a particular initial debt level that you have, what happens if you, precisely as you seem to indicate, want to change the growth assumptions or the interest rate assumptions. So I find your criticism a bit odd. I mean, it's not the point of saying that that's a reasonable assumption for Greece at all.
I mean, and now we're sort of outside what's in the report. I think that one of the characteristics of these types of sort of episodes in a number of countries, particularly when you do IMF programs, is that you sort of do these programs over and over again, and they are revised. Or sometimes you say that you start a second program or a third program. And that's because it's just simply very, very hard when you start out down these paths trying to restore things to early on exactly know and fully understand how things will evolve. So in that sense, this is sort of a process that takes a number of years. Sometimes they stay nicely on track, then all of a sudden they go off track, or you didn't fully realize what was going on in the economy, so that you have to sort of redo the numbers. The only thing these illustrations do is that they sort of show that you're going to have to be at it for a number of years, and that won't go away.
I have a question concerning the latter part of that. At least I thought there was a slight change. There was a very subtle change in the repo rate for the next forthcoming meetings, as far as I can see. 10 or between 5 and 10 basis points perhaps. Still, if you pan it out for the next couple of meetings this year, it would seem to indicate that you signal, so to say, that there will be a September hike. Is that correct to view it that way? So were you unclear here on this point before, and now you have clarified the situation, or do I overinterpret things here?
Monetary policy isn't done in that way. It's not that you need a magnifying glass to detect semi-secret messages. No. That's that's not how the world works. I mean, you get all the arguments eventually in the minutes, and if you read past minutes, which I'm sure you have done, that kind of subtlety is
change.
That kind of subtlety is not there. But still, given that time moves, then that also means that something happens when you have to draw the graphs. But Patty.
I mean, what we had to do technically was to price in the 25 basis points that the hike implied, because there wasn't 100% probability before that would be raised. So, and then I think you might be right. There is I think it's actually something like 4 basis points a difference if you look, and that's kind of a smoothing. I mean, you have to also have a good-looking graph that it doesn't look strange with small. So, but it
a small point, but to some of my colleagues that are trading these instruments, it's important whether it's September or a later occasion. So
No, we do understand that this is sort of part of the conversation, and this is what what always some people sort of look at and argue about. But that's not how these decisions are made.
I guess from the quarterly average that you now can see that is published, you can compute more or less precisely what. So it's not unclear if that's a problem.
Content with the answer, yes.
Yeah.
Not to get ahead of the wage round that is coming, but you indicated 3.5% wage growth, but you also have an unemployment rate going up to 6%, which might be full employment, might be even above it. How do you see this working out? And you also saw in the report that there are some matching problems for certain companies where there are lack of skilled workers, or it's increasing at least.
Right, but maybe oversimplifying, but if you go back and just sort of optically look at these graphs, our projection is sort of very normal in some sense, and so are the wage increase assumptions that this is based on. I mean, things can of course always happen in the economy, and it's hard to know what's going on in all its sort of detail if you look at under the aggregates, arguing about the labor market. But that's basically what it is, and we haven't seen any reason so far to come up with other assumptions.
Can I just add? I guess we're sort of envisaging an unemployment rate that would not cause too many problems. That would be some percent or so lower than the average that we have had over the last 20 years, and we try to discuss in the box reasons why we believe that that's reasonable. It's not only related to the fact that some structural reforms have been undertaken lately, but it also has to do with some deeper reforms of the economy over the last 20 years or so. So it makes sense to believe that, you know, we could do better than an average over the last 20 years. But then the question is, could we do even better than that? Maybe, maybe not. Who knows? Minister of Finance seems to believe that, and the NIR seems to believe that under certain circumstances. So it's a difficult issue, and one will have to see as time goes by and see what the labor market is doing, and then gradually change the assessment if it looks differently than we have assumed at the moment.
Okay, if there aren't any more questions, reflections on monetary policy this Tuesday in July. On our side, thank you for coming, thank you for listening in, and let's hope that all of us have a nice summer ahead. Thank you.